You know, what's interesting about the time that I entered into financial services wholesaling is that the industry was under massive change. Just to give you an idea, that change began somewhere in the mid 90s with a bill that allowed banking to occur across interstate lines. So it used to be that you couldn't have a First Bank of Chicago account, that is, in a branch in Minneapolis. That wasn't a thing. The First Bank of Chicago operated in Illinois and only in Illinois. And if you wanted to bank in another state, the banking had to go through the Federal Reserve, who was the central banker, and then they squared the account from banks in other states for you. That changed with a bill that allowed interstate banking to occur, and so by the late 90s, I was interviewing, and I actually interviewed with a bank out of Ohio for a PAC administrator. They were looking for someone to run their political action committee fund database mostly, and they were moving the job from Ohio to Milwaukee, because apparently the people in Milwaukee, according to the gentleman who interviewed me, are much nicer and much easier to get along with. Who knows? But you know, when I started wholesaling, what was interesting was that I was going into offices, and suddenly I was discovering that the financial services industry over the last probably 10 or 15 years had gone through massive consolidation. I sat down in an office for Smith Barney in Rochester, Minnesota, and the guy had his business cards lined up in a frame, 7 of them. And he says, "Bob, I've been here," I want to say it was 24 years. He says, "I've been here 24 years. I've worked for 7 companies. I've never switched the desk." That is consolidation. And that was the same consolidation that I continued to see when I became a wholesaler.
Smith Barney. They make money the old-fashioned way. They earn it.
One of my first accounts was First Union, which is an East Coast financial services firm. First Union was bought by Wachovia. First Union, before being bought by Wachovia, had bought Evergreen out of Wisconsin. And so I started to go Evergreen, First Union, Wachovia. I eventually took over A.G. Edwards, and as you know, A.G. Edwards was bought. And so I was watching this constant consolidation within the financial services company. UBS PaineWebber became just UBS. And so in this period of time, I thought, wow, this is just an incredible time to be in this. There's so much change. There's so much money rolling around. There's so much opportunity that it's important to understand that in that environment, I really began to feel like I had achieved my goal of being a future yuppie of America, right? I was on my second BMW, a black on black 525, and I had a house. I just bought a brand new house, 3,200 square feet with a gorgeous kitchen. And it was the beginning of probably 10 or 11 years of just really egregiously living well and enjoying myself and enjoying the spoils of working in the financial services industry. You know, the thing was, I remember sitting in a meeting in Richmond, Virginia, and my boss's boss was there and said something to the effect of, "Hey guys, the commissions we pay are a good thing. They're positive. They're a cash flow. They say that we're selling things." And at the time, it meant very little to me. And then as I started to understand more about how insurance and long-term care insurance and reserving worked, I started to look at that model and go, man, we're spending way too much money for the premiums we're taking in, to the tune of, like, it's going to take us at least 2 to 2.5 years to recoup the money we need to put into reserves. And you have to put money in reserves in the first year, which meant we had to be borrowing large sums of money in order to put the reserves in place that were supposed to be there. And it turned out that that was exactly what was happening. And in fact, GE was sued in a class action lawsuit for classifying these commissions as a net plus on the cash flow side. And as these things started coming forward, and I started looking around and forming my own opinion about what was going on, I started to realize that this model in these wirehouses was not probably going to be nearly as profitable as they'd hoped. And so I came upon my first direct bubble. And when I say direct bubble, what I mean is we were switching products. And since we were switching products, we had all of our brokers go out and solicit every last piece of business that we had run a quote for in order to close that book of business before rates went up. And I think I had a really good month, like 60 or 65,000 or something like that. And I remember to myself, like the day after that last app had to be in, you had a period end of month and then there was some honeymoon. But I remember looking back at that business and going, wow, I have literally just destroyed my entire pipeline, and I now have to rebuild that pipeline from zero, and that's going to take 4 to 6 months. And to be honest with you, I started having questions about the model, and so I actually applied to some other jobs within GE, and lo and behold, the first call that I got was from a gentleman from GE Mortgage Insurance. And I interviewed briefly over the phone with him, and he was interested in bringing me out for an interview. And I must have missed a number of emails because at that moment, or at least within the day or so, I got a call from my boss, Stan, and Stan said, hey, I just wanted to get your thoughts on this, change that's coming. And I said, I'm sorry, I must have missed a memo here. Explain to me exactly what's going on again. And we were being switched from working with wirehouses to working in the brokerage general agency. When I was working as a wholesaler in the wirehouses, I used to ask myself, so if Genworth is doing, $120 million or whatever it was a year in long-term care insurance, and we were about a quarter of the market, one in every 4 long-term care policies sold was a Genworth policy. Who were the other 3 people who were selling this, and where were they selling through? And it turned out much of that business was being done through the brokerage general agency channel. And I'm not going to bore anyone with that story of what they are because I'll talk about them in more detail in probably a future video. But suddenly I was in a different team and I was working in a different channel, and the sales model for us was different. Whereas in the wirehouses, although I was called a wholesaler, my real role was as a retailer, was to sit down with the clients and to do the sales call itself. Probably 80 or so % of all my business that came in was a direct appointment that I held at one point. And I was going from having a goal of probably, $300,000 a year to, hey, Bob, your new goal is $2.5 million. And I went, oh, hey, there you go. And this model was much different. And in this model, we would deal more directly with sharing just the story, and they had their own wholesalers, their own internal sales teams. And in this model, I had an opportunity to mold some brand new, important, and long-term relationships. And to do that with the owners of the company who had actual control over what was happening in their business. Oddly enough, Minnesota was a powerhouse in long-term care insurance. And so I worked with companies like Newman Long-Term Care, and I worked with American Financial, and a number of other agencies like that. Because I was in the Twin Cities, I handled Lutheran Financial or Thrivent Financial for Minnesota and Wisconsin, and the headquarters was often a place that I would visit, or a couple times, and I would do a presentation on parts of the product for Thrivent's own internal sales team, which was really unique. Those years were some of the best years of my life because I thrived in that environment, working directly with the account holders and their wholesalers, and at Newman with their career force, with their own in-house agents. And those relationships taught me a lot about the value of building and building business. I wasn't there to take half of the business from the competition. I was there to double their business and then take half of their competition's business. And as it turned out, by the time I left, I want to say I was up to 6 or 7 million a year in business. So I did. I grew the business significantly, very significantly. In 2007, I bought a Hunter 26 sailboat, and we put it in a marina over in Oconto, Wisconsin. And I'll tell the story of my first sail in a different video because it deserves its own story. In fact, all of my sailing shenanigans deserve their own story. But that summer, we spent the 4th of July on a sailboat trip up into Door County for the first time. And in particular, I think it was the 3rd of July, we pulled into Fish Creek on a very, very hot day and said, hey, we're going to park here and go swimming, give everybody a break. And actually, I have a conference call coming up this afternoon that was suddenly announced. And so we pulled up, dropped anchor, and I think it was about 2 o'clock in the afternoon I got on the conference call. And on the conference call, they were announcing to the wholesaling team that we were going to have a rate increase on in-force business. For 34 years, Genworth had been the oldest long-term care insurance company in America, beginning as Fireman's Fund and then Amex Life. And then Amex Life was bought by GE. And in 2004, GE did something they've never done before. GE IPO'd, that is, they did a public offering of just their insurance arm that included life insurance, long-term care, annuities, and mortgage insurance, as well as some assets that were in Europe as well. GE had never done that before. I wasn't really aware at the time why GE would do this, but in 2007, when they announced that they were going to raise rates on in-force business, I suddenly questioned exactly why things were happening. Long-term care insurance is a product that takes 30, 40, or 50 years for a claim to happen. And in that period of time, as all insurances do, you have to reserve. And you make assumptions at the beginning of those policy series as to what your interest rates are going to be like. And most insurance companies were beginning to get caught in the interest rate environment that had been created by Volcker in the early 80s. You see, inflation had raged and Volcker raised interest rates really, really high. And from 1982, interest rates began falling. And they continued in aggregate to fall until 2001, when the tech bubble crash happened. And in a response to the tech bubble crash, the Fed dropped interest rates to nearly zero and left them there for an extended period of time. I want to say 4 or 5 years. In 2007, fearing a bubble, the Fed raised interest rates. And in part, that affected the reserving rates all along the way of insurance companies. And long-term care insurance would be one of those. That was the moment I became consciously incompetent. That the interest rate environment of our company and of the world played a very large part in the stability of our business. And it would be just a very short 2 years before I would have a very sudden and abrupt awakening. I'm going to stop this story here, and I'm going to leave you with this idea. I had achieved Future Yuppie of America status. I felt confident that I knew exactly what was going on. And in a very short few years, that entire thing was going to crumble. I thank you for your time today. I thank you for the time to listen. And I hope you have another excellent week or two. And I'll be back probably mid-August with one more. And then I'll be back after the holiday. Peace.